Hello, everyone. Welcome to Asian Leadership Conference hosted by 조선일보. I'm Sungwoo Kim, who is head of Environment and Energy Research Institute at Kim & Jang, the biggest law firm in Korea, with the dedicated climate change and ESG team that I belong to. As a 28-year experienced expert, I will be moderating today's webinar under the theme of increasing value of ESG in the Corona age. It's pretty exciting to preside this webinar since many people are talking about ESG recently, filling up their inboxes, and I think we all would like to have a clearer and broader view of ESG. We are very lucky today to have a global leader of ESG society, Naomi English. She's a global head of ESG solutions at MSCI, which evaluates more than 6,000 global companies on ESG, and I think she's really a real expert in this field. I think that the webinar will not last more than 40 to 45 minutes, so please stay tuned. And Naomi, thank you so much for joining us today. And please introduce yourself to the lovely viewers of our webinar and introduce your MSCI and practice that you are leading. Over to you.
Thank you, Sungwoo. And thank you also to the Asian Leadership Conference for inviting me to participate. I had the honor of participating last year in person in Seoul, and it was one of my most memorable experiences. So I'm so grateful to be here today. So my name is Naomi English. I work at a firm called MSCI, and I've been with them for the past 12 years in various roles, 10 years in London, and then 2 years ago, I relocated to New York, where I head our ESG product strategy, so designing our ESG products. For those of you who are not familiar with MSCI, we provide content and tools to help investors make better investment decisions for a better world. In particular, and the area that I focus on, is we provide environmental, social, and governance ratings and research and data spanning nearly 15,000 companies. We also provide ESG indexes. We have over 1,000 ESG equity and fixed income indexes, and we have some very powerful ESG analytical tools. So we work with more than 1,400 leading investors globally who use our content and our tools throughout their investment process, from setting their investment policy to selecting stocks, portfolio construction, risk management, as well as reporting back to their clients.
Wow, that's wide variety of products and the influence that you have. Let us begin our discussion by introducing ESG and the impact of COVID-19. Please put the slide number 1 on the screen. As you can see from the slide, the ESG is non-financial factors considered during investment decision-making process, as just Naomi mentioned. And once company disclose non-financial information through CR report, etc., rating agency use them, and by checking with the companies, of course, to provide a rating for each company, like credit ratings. Then the investor use them with their own policy to engage with the company. One good example, back in June, 995 businesses, just global companies, committed net zero target in 2050. And against the backdrop of that UN-backed campaign or initiative, there are 450 institutional investors managing $40 trillion of asset are behind this campaign. So I think it's really the investors are the moving toward toward the ESG, and it seems to be working. So my question for Naomi is, has ESG been mainstream before COVID-19 even, and even during the COVID-19, and what is the prospect post COVID-19 of ESG?
So over the last 10 years, we've seen tremendous growth in ESG investing. We've seen it go from being on the fringe of investing to really becoming the mainstream. And perhaps one of the bright spots of 2020, which has been a very challenging year, is that we've seen this acceleration in the ESG adoption over the past 6 months. It's really been quite tremendous. So if we look at one organization, the United Nations Principle for Responsible Investing, they now boast more than 3,000 signatories who are responsible for over $100 trillion, and they've committed to integrating ESG across all of their investment decisions. Now, 1/4 of those signatories signed up this year. So you can imagine, with everything else going on, nearly 7,500, 750, pardon me, investors have signed up to the UN Principles for Responsible Investing. Now, since the beginning of the year, we've also seen tremendous and record inflows into ESG and sustainable mutual funds and exchange traded funds, as well as outperformance by those funds. And so previously, we had identified that ESG characteristics can help companies to better manage risks. And what we've seen over the past 6 months that's borne out. And the COVID-19 pandemic was really one of the first tests, big systemic shocks that the industry has seen in the past decade, where we've seen this growth in ESG. And what we saw was that companies actually were quite resilient and performed well, where they had strong ESG performance and scores. And so, if anything, COVID has further emboldened this movement, and investors, I believe, realize the greater importance of focusing not just on the social issues that have been more prominent, whether it's this systemic health risks that we're seeing, how companies are handling their supply chain, how they're handling health and safety in the workplace. But also we believe will likely encourage investors to focus on other systemic risks, such as the environment and climate change, which are also very hard to measure, but very relevant and potentially financially impactful. So yes, ESG was becoming mainstream before COVID. I think COVID has further demonstrated the relevance of ESG as a financially material factor. And I think it's safe to say that ESG is here to stay.
Okay. Wow, that's really surprised me that just 1/4 of the investors of $100 trillion just signed this year, although despite the COVID-19. Well, it sounds like that the ESG is getting more attention even with COVID, and the COVID sometimes COVID facilitate the ESG. Then how about the bottom line? You just mentioned a little bit about that, but I'm just wondering, and many people I'm pretty sure must be wondering, the all investments supposed to make money. So if please put the slide number 2 on the screen to compare some numbers that I just prepared for. Naomi already mentioned some of that, but let's just pretty much focus on a little bit more on bottom line. Please, they put the slide number 2 on the screen for me. This is slide number 1. Okay, this you got it. Slide number 2. As I said, the number comparison on of the ESG performance. The past 5 year, the UK funds return rate was 9.1% for sustainable funds, which are same as the ESG funds. Whereas the funds investing broadly across the British stocks were negative 0.1%. So it's a huge difference. And also, Naomi mentioned about the inflow, that globally at the first quarter of 2020, the cash inflow into sustainable funds was $26 billion, whereas there were $385 billion were outflow out of the basket across the whole funds. My question is, maybe I'm just picking up some numbers at the corner. I don't know. You're just out there. So what is the reason for the outperformance that you see and cash inflow to the ESG funds? And is it sort of low because low exposures to energy sector, or is it because the heavy exposures to tech giants, as some people mentioned? What's going on out there about the bottom line?
So it's interesting to see the statistics that you show. And there has been a lot of attention recently on the past quarter or 2 quarters during COVID and the outperformance. But I like that you highlight the last 5 years, because the recent strong performance has really reinforced a long-term trend that we've been observing. And we've seen a growing body of literature and studies demonstrating this relationship between strong ESG scores and performance on the one hand, and strong financial performance. And one study that MSCI conducted showed that companies that had a strong ESG performance or strong ESG scores were, first of all, more competitive. They had abnormally high returns and had higher profitability. Secondly, they were able to better manage company-specific business and operational risks, and they had a lower likelihood of suffering incidents that might impact their share price, whether it's corporate governance scandals, environmental spills, etc. And then third, they had a lower exposure to systematic risks. They had a lower cost of capital, and therefore they had higher valuations. So that's just one study, but we see many studies that are starting to show this positive relationship, in particular when it comes to risk management, so managing the downside risks, but also in some cases that it can actually lead to outperformance and better alpha. Now, not every single fund in every geography, in every asset class is going to outperform just because you have a high ESG score. As you know, there are many different factors that are driving this. I think it's useful to note that different ESG ratings and scores by different providers do have different methodologies, and they don't all aim to measure companies' resilience to these risks. And so at MSCI, the goal is to measure and to identify which companies within an industry are the leaders in managing potentially financially relevant ESG risks, and which are the laggards. And by taking an industry relative approach, it allows portfolio managers to construct sector neutral portfolios where they can still have a diversified portfolio and get exposure to different sectors, but to pick the companies that they believe are more resilient and able to manage those risks. And so this is really an approach about what is potentially financially relevant. And this is a concept that there's much better understanding of throughout the industry. versus perhaps the historical view was that ESG was purely about investing along one's values. And so for many investors, they felt that if they wanted to make money, they couldn't invest in ESG because they were contradictory, I think, to what you alluded to. But our ratings are, first of all, this is still very common. Many investors do want to invest along their values. But now there's this view that you can also use ESG to make better investment decisions. And so in terms of different sector exposures, many of these funds don't necessarily exclude entire industries or overweight certain industries. So if you look at the tech giants, a number of the big tech giants actually have very poor corporate governance or poor data privacy concerns, and so that lowers their ESG scores, and so they might be excluded. So in certain regions, and like in the United States, historically we have seen some underperformance on the ESG indexes where they've been underweight the tech giants. So we do see some regional variances when it comes to outperformance, but we have seen a very strong persistent message in many of our global indexes that show outperformance over a long period of time. And during the COVID-19 pandemic, we saw that our 4 global ESG indexes did outperform their parent benchmarks.
Wow.
Now, I think that was the one question on outperformance. Maybe I'll touch briefly on the cash inflows. It has been quite notable that over the past decade, we've seen modest growth when it comes to inflows into ESG and sustainability funds, but we've seen quite an acceleration in 2019 and 2020. I think year to date, inflows into ESG ETFs have been more than double what they were at this time last year, and those were more than double what they were the year prior. So we're seeing quite a big increase. So what's driving this acceleration? It's hard to pinpoint. We believe it's a combination of factors. So when we look at the growth in ESG, we think about 4 key drivers. The first is that investors are becoming less tolerant of ESG, corporate ESG incidents. So investors are more aware of what's going on with social media. The second something happens with a company, everyone knows about it. So it's in your face, you're aware of it, and there's just a greater social awareness of climate change, of social inequality, racial inequality. These issues are much more present, and this greater awareness and lower tolerance is emboldening people. The second reason is that investors are demonstrating that they're willing to act. They're actually willing to invest significant assets into these sustainability funds. We particularly see this with large institutional pension funds and other owners of assets and capital who are putting pressure on their fund managers and who are providing the needed seed capital to help many of these funds to gain traction. So we saw last year a few ETFs that were actually the largest ETF launches in history, practically, I think in the past 15 years. These were sustainability ETFs, but they were bigger than any ETF. And we saw some very strategic asset owners, European insurance funds, putting significant capital in those ETFs. And that sends a strong message and it encourages others to also put their capital into those funds. The third reason is that better understanding of the potential financial benefits that we talked about. We have a longer track record now. All of these funds have been around longer. If you talk to any investor, they always want to know, what's the track record? They are not likely to invest in a brand new ETF. And so partly we've seen a longer track record that has, and a better understanding that this is potentially financially beneficial. And then the fourth is improved ESG ratings. At MSCI, we've invested significantly in our ratings. In particular, we've expanded the coverage. So 10 years ago, we covered 2,000 companies. mostly developed market, large companies. Since then, we've expanded to nearly 9,000 companies with our core ESG rating. And that includes emerging market companies, smaller cap companies, private companies that only issue debt and no equity. So we're really expanding our coverage universe. And what that means is that now asset managers and fund managers can launch funds and strategies for those different asset classes and geographies. And that means that investors who are looking to invest ESG across their entire asset allocation are able to do that, whereas they couldn't do that in the past. So we've seen an explosion in the number of ESG and sustainable products. I believe in the United States, it's gone from 150 to nearly 1,000 in the past decade. And when you expand that to the different types of share classes, it's significantly larger. And so having more options also makes it possible to invest. So many different factors contributing to the inflows.
Wow, I think that there are many the different kinds of the backgrounds for this, the bottom line of the ESG funds and cash inflow into the sustainable funds, but that all going to one direction, converging into the ESG it makes value, and ESG gives an opportunity. I think it's good for investors to catch two rabbits at once. Then how about the investors' engagement with the company, as you just mentioned briefly, which is on the other side of the coin. Please put the slide number 3 on the screen. If you just, as you can see from these boxes, there are some options that investor can choose to engage with companies. For example, active communication, as BlackRock sent a letter to portfolio companies early this year to ask the climate strategy. And as the second option could be shareholder resolution, that back in May, the BNP Paribas filed this resolution and make it pass to ask Chevron to disclose lobby activities alignment with the Paris Agreement. And litigation and divestment is always another option, a little bit strong options that the investors can choose to engage with a company. Then my question is, what is the investors' most favorite pick among those engagement type, and where will this engagement be heading for in the future? Will there be more the disclosure requirements? Will there be more action requirements, or will there be more sort of governance monitoring requirements, or mixed of them? I'd like to have your thought on that.
So first of all, I think engagement itself is a very important and crucial part of the active investment and shareholder responsibilities. And when we've done some of our studies that look at the financial performance of companies, what we've found is that companies that are actually improving their ESG, you see the biggest return in terms of financial performance. And it makes sense. The companies that are doing a superb job are already benefiting. Their share price reflects what the leadership that they've taken on sustainability. But companies that aren't doing so well and are actively improving their ESG performance, they're the ones who are benefiting from improved efficiency, from tapping into new markets, managing risks better, lowering their cost of capital, etc. And so engagement is a key tool in helping companies to improve their ESG. So as an owner of a company, by actively engaging with them and helping them to improve their ESG, you hold the biggest opportunity to reap the benefits of that improvement. So engagement is tremendously important. And overall, the trend that we see is is engagement becoming more important and more central and a key way that asset managers can differentiate themselves. So it's not just about investing in a company and walking away. It's really about identifying those companies where an asset manager can influence and help them to improve. And so in terms of those 4 different approaches, I think, first of all, it's to be a combination of all of these. So anytime that we are driving for change, you have to have a variety of different tools in your toolbox that you can use in different situations. I would say the most common is active communication. It's the lowest hanging fruit. Portfolio managers can incorporate questions about sustainability in the conversations they're already having with company management. It can be very effective. It can be done one-on-one, or you can also have collaborative engagement where various fund managers combine their efforts with others to have that dialogue and to demonstrate and to help prioritize for the company. Shareholder resolutions have been quite effective in demanding more transparency, commitment, climate stress testing in particular, when you look at the big oil majors. And they've seen some great results in certain companies in terms of them providing more disclosure. The trend we're seeing there is that there's more positive support from fund managers for shareholder resolutions. So we're seeing more activity from BlackRock and others who are voting in support of sustainability shareholder resolutions more frequently. And so I think we'll continue to see that as an option. And then the divestment, I think, has a mixed record. It's a bit more controversial. The key reason it's controversial is that if you divest from a company, you lose your position and ability to influence that company. And so what is really the impact of divestment? Now, if you have mass divestment where the entire industry is going out, of course it can have dire consequences, but it really does take quite a coordinated systemic divestment to have that kind of impact. But it's important in some cases for that credibility. And so we've seen some examples where large Nordic pension funds divested from large companies after trying engagement for years and not getting the results they were looking for. Then they had to have an alternative. And in that case, it was to say that they had tried and they were not successful and they would walk away. And then I think the litigation is very interesting. We've seen a few recent high-profile examples. Also, the city of New York suing oil and gas companies. So it will be interesting to see if that is something that is used more often, especially as we start to see the very real costs of climate change ravaging cities around the world, whether cities will turn to litigation to help cover those costs. Perhaps one other form of engagement, which is quite unique, is what we've seen Japan or the Japanese government pension fund doing, and we've partnered with them in terms of what they've done is they've constructed ESG indexes that capture their ESG preferences, and they've made it clear that because these are rule-based indexes, that companies that don't meet those ESG criteria will not be included in the index and are therefore not included in the end investments. Now, the pension fund has allocated significant assets, and so as a result of this, it's kind of an indirect form of engagement, but we have seen tremendous increased activity by Japanese companies coming to MSCI and verifying the data. So for all companies that we assess, we give them the opportunity to review the information that we've collected. And over time, we've seen that increase. But in Japan, as soon as GPIF launched these mandates, we saw the response rates increase from 15 to 20% to upwards of 80%. So tremendous activity followed by more disclosure by these companies. So it's been very effective in the Japanese market in getting corporates to provide more transparency and be more aware and engaged on ESG. And so that's been a very interesting case study to observe.
Oh yeah, of course. It's the Japanese case that you just took. The government pension fund really attracts our attention as a Korean based viewers. We do have the third largest pension fund in Korea by ourselves, and it has huge influence to the financial market and also the company's engagement. So I think that's really interesting. So that naturally lead us to the next topic. Let's shed the light on Asia rather than the Europe and EU, which has more than 10-year history of ESG. I think that Korea, Japan, we just have 1 or 2 year of ESG history, very short. So from my observation as an expert in this field, Asian executives, many Asian executives, not all of them, but many of them have a tendency to think ESG is CSR. So what happens is when the crisis like COVID-19 comes in and hit the bottom line of the company, the ESG as recognized as a CSR would be dropped at first, would be slashed, the budget will be slashed, the department will be just gone, and et cetera, et cetera. That's the decision. And going back to the old ways, the sort of giving the crisis like COVID-19 giving the excuse for Asian companies to giving back to old ways, always chasing short-term profit, which we cannot blame for. My question is, do you think that the Western investors, as the shareholders, with a 10-year of the ESG history, do you think they will remind Asian companies that the global institutional investors really care for sustainability and long-term horizon in the middle of the COVID-19 and even at the COVID-19, at post-COVID-19 society? And how would that happen?
Yes, I think it's very valid. We're in a crisis. And so companies are doing what they can to survive. But I think you made a really good point that as long as it's viewed as CSR, it tends to be seen as non-core. This is not core to our business. It's philanthropy, it's community engagement. They're peripheral activities that aren't core. And when budgets are tight, when resources are scarce, then there needs to be focus, and they focus on the core activities. That said, with ESG, and as we touched on earlier, ESG is really about considering what is materially relevant for my business. And when it's viewed from that perspective, when it's viewed as what could financially impact me, what are those risks, what are those macro trends that are happening that are potentially going to come and affect me, then it becomes core and is less likely to be slashed. And we are seeing actually certain companies rebranding a bit. Instead of having a CSR department, they have heads of ESG as well, who are working with different business segments and operations on what's really core. So I think that to your question of will Western investors remind them, absolutely. I think that what we've seen over the past decade is ESG is becoming core to asset owner mandates. So when they are looking for new asset managers, whether they're working with consultants or directly, this is a core topic of discussion, is to what degree the fund managers are embedding ESG. Now that we've seen with COVID-19 how top performing ESG companies have been more resilient and able to manage their supply chains and their employee workforce. It's becoming even more core. And so I guess the question is, how does this translate to the actual companies on the ground? I think they're going to see that investors will be making decisions to not invest in companies or lower their exposure to companies that have poor performance. And they're also going to engage these companies, ask them more questions, understand how are they managing their supply chain risks? How are they managing health and safety in this new environment? What are their practices for employees who are having to be present? What is the option for working from home? What's the flexibility? How are they retaining talent in this environment? So those are the types of questions that investors are going to be asking to companies, because COVID has shown that a major pandemic is possible, and another one is also possible. And the companies that are not are only focused on today and are not looking at 6 months, 12 months from now could be in for a very nasty surprise if we do have either a second wave or a whole other pandemic or other catastrophes that are possible.
All right. See, I think it's pretty clear that investors see their portfolio company from ESG angles more and more, even after COVID-19 crisis, and it give give a better value for both the investors and companies itself as well. I think that it'll be speaking of the engagement that you just mentioned. Let's focus on the case of BlackRock. Having sent a letter to Korean companies only this year, as you know, I think it'll be helpful a little bit for the Korean companies. Only this year, as I mentioned, the BlackRock sent a letter. Larry Pink sent a letter to the portfolio companies to prepare for the climate strategy by the end of this year. So this is first time for Korean conglomerates and Korean CEOs to receive this kind of letter with related to the climate strategy from the board, from the shareholder, to be ready by end of this year. And can you sort of give some tips for Korean companies who just received this kind of letter or pressure for the first time this year? Any tips for the Korean companies to succeed in better disclosure and succeed in better management and better engagement with their investors, because this is first time for them to comply with global institutional investors or Western investors as a shareholder from ESG perspective?
Yeah, so it's very interesting. What we've seen in the past, I'd say 2 years, is climate has really elevated. It's become a standalone ESG issue that is really kind of split out and is on an even playing field as ESG. And so what we're seeing is that the investors increasingly are having a dedicated and distinct ESG strategy as well as a climate strategy. And so I think the actions from BlackRock requesting companies to have a climate strategy speaks to how central of a risk investors see climate change, and they're taking it very seriously. It's also kind of risen in parallel with the Task Force on Climate-Related Financial Disclosures, the TCFD, which provides a framework both for investors as well as companies on how to really measure and manage climate change risk. And so that's been incredibly instrumental in, I think, helping companies understand where to start and how to go about this. And so my recommendation is take a close look at the Task Force for Climate-Related Financial Disclosures. It's a mouthful, TCFD, and follow their plan and their guidelines. It really talks about, first of all, understanding the governance, who in the organization is responsible for climate change, and thinking through the accountability mechanism. It then looks at risk management, at certain metrics, and then targets. And my advice, and I'm not an expert when it comes to actually doing this work within companies, but from working with investors, is that there's no right answer. Climate change is very complex. It's different for every single company, and it requires, I think, curiosity and a real desire to understand and anticipate these risks and to be taken seriously, and then to have an honest conversation with investors. It's going to be iterative. There will not be a perfect disclosure and report in year one, but doing something is better than nothing. And having open and honest dialogue with investors and asking them what they want and partnering on this will make their work much easier. And so I think for companies, it's about just starting, learning, measuring what they can and disclosing, and then working with their peers in their industry, working with investors to understand what can they do next and how do they move forward.
Right, then I'm sure that's really helpful for the Korean leaders and practitioners as well. Well, time flies. I think before we wrap up the session, webinar, I think I would like to ask last question on ESG bond. And let me just take an example of Korean case again. Please put slide number 4 on the screen, showing the ESG bond issuance in South Korea. As you can see from this exponential growth, we used to, in Korean companies, the financial and just corporate, we used to issue like $500 million in 2017, but last year it went up to 12 billion, and this year we already went over the number of last year. At the first half of this year. So it is moving right now. I'm just wondering, since you are providing ratings and the products related to the bond and funds, my little bit of worry based in Seoul is the ESG bond issuance is really skyrocketing right now, whereas we do not have maturity, ESG maturity of market, institution, and acknowledgement. So it seems that the bond issuance is going beyond than enabling environment and maturity of the society. What do you think? What should Korean investors and Korean issuers of ESG bond keep in mind from that perspective?
First of all, I think it's very exciting to see that corporates have now entered. I mean, I think we've seen in Korea that it started mostly with government issuers and some Korean utilities that are issuing bonds, and now we've seen corporates increasingly becoming more active. And so I think it's great to see that activity. It's a sign of a step in the right direction, and so that's, I think, fantastic. So MSCI, in addition to doing our ESG ratings and assessments, we also partner with Bloomberg on the Bloomberg Barclays MSCI Global Green Bond Index. Another mouthful. And for the past 4 years, we've won the best index of the year from the Environmental Finance Bond Award. So it's the best green bond index. And so we look at green bonds and evaluate them very closely. And so we've been monitoring this trend in Korea and seeing the growth in bond issuance. And despite this big increase, we actually see very few Korean bonds on the index. And there's, I think, two key reasons perhaps for that. One is many might not meet the size requirement, which is just, it's not a question of what type of green criteria, it's really just that they're not big enough. So that's one reason they might not be included. But the other reason that we've started to notice is that we are not able to engage with the bond issuers to get more information that we need in order to assess and determine what is the criteria and whether we consider it, whether it passes the MSCI assessment for being a green bond, which then enables it to be included in the Global Green Bond Index, which then opens them up to investment from institutional investors around the world. So one of the largest ESG ETFs globally is a green bond index in Europe, and it has, I believe, nearly 2 billion in assets under management tracking it. So overall, still relatively small, but growing. And so my ask to the Korean companies who are issuing bonds is that it is to be receptive and looking out for MSCI reaching out to you and asking for clarification on the use of proceeds and the frameworks and reporting, because doing so would make them eligible for inclusion into the Green Bond Index and give them additional investment opportunities. So I think that's my main advice, is looking at those international frameworks and benchmarks, because if they adhere to those, they can then benefit from the international investment community and outside of Korea.
All right, I'm pretty sure that's really helpful. Time flies. Do you have any last words for our lovely viewers of the ALC webinars?
Well, first of all, just thank you so much for having me. I believe that ESG really presents a tremendous opportunity for everyone, and it's a bit daunting and scary for those who are not familiar, but it truly is an opportunity for institutional investors who are looking to make better investment decisions and attract new clients. It's also an exciting opportunity for companies to differentiate themselves and attract more capital at a lower cost. And it's a great opportunity for individuals who can now make better investment decisions for themselves, for their preservation of their wealth, but also to create a better world for future generations. So I'm excited to see the activity and momentum in Korea, and it's already progressed since I was there last year, and excited to see what will come in the next year.
All right, thank you so much. I think your insight was really helpful, and thank you so much for your time out of your busy schedule. I know how busy you are at the end of the break, and you just came back to this is first day, but you participated in this webinar. It's really appreciated. I also would like to thank the viewers of Asian Leadership Conference webinar series to joining us to the end. And please, make sure that I hope to see you all at the main Asian Leadership Conference in November. So we'll be back. So stay tuned and wait for us, and have a really good day. And Naomi and all the viewers, thank you so much.
Thank you.
Thank you. Bye.